the Kelly criterion lives in a binary world where your answer is either yes or no. It's either worth the wager or it's not. And in the stock market, even if you want to narrow it down to a binary world, it's not. There are a whole lot of ranges of outcomes. You could be right and make 15%, but the stock could double. And these are all different situations that you need to be able to factor in probabilistically thinking about the odds and the likelihood. So there are two ways that we as investors could approach this situation. We could either simplify and try to narrow it down to a binary world where it's either yes or no, and you have a very clearly defined area of where you think the reward side is and the risk side lies. And that gives you a trigger point of whether you should invest or not. And not necessarily use it in terms of how much to invest, but use it in terms of a trigger point. The other thing that we could do is, as situations evolve, you can make reassessments of your odds and probabilities, and in the relationship between these reassessments of the odds and probabilities and your past assessments lie a whole lot of information. And this is other people, it's called the Bayesian approach. Using Bayes' theorem to think about the relationship between your new information and how that relates to the past information and what that says about where things stand. So to that end, one of the things I like to do is use the position management side to really help rig Kelly in your favor. And the way to do that is to take a longer term approach to these situations and move slowly and not necessarily buy into a full position all at once, but buy into it when you could get more confident in your assessment of the odds. Some of the best situations are really, the market is slow to update to new information. One of the documented inefficiencies that the efficient market theory people talk about is something called the post-earnings announcement drift. And you see this play out with earnings or with pivotal news. But the market doesn't know how to fully price this information right away. And I like using these bits of incremental new information to really revise my thesis and use it to be able to more confidently have an idea of how much I should be willing to give behind each wager.